Question 1. A client is concerned about the potential for their bond portfolio to lose purchasing power due to rising inflation. Which of the following bond characteristics would offer the best protection against inflation risk? A. High coupon, short maturity bonds. B. Zero coupon bonds trading at a deep discount. C. Bonds with a fixed coupon rate and long maturity. D. Treasury inflation protected securities, TIPS. Answer: D. Treasury inflation protected securities, TIPS. Treasury inflation protected securities, TIPS, are designed specifically to protect investors from inflation risk because their principal value adjusts semi-annually based on changes in the Consumer Price Index, CPI. While the interest rate is fixed, the actual interest payment will increase as the principal value rises with inflation, effectively preserving purchasing power. This feature directly addresses the concern about inflation eroding returns, unlike other bond types that offer fixed income or are more susceptible to interest rate changes. When thinking about inflation protection, remember that TIPS automatically adjust to maintain real returns. Question 2. An investor is considering a direct participation program, DPP, focused on real estate. Which of the following is a primary risk associated with investing in most DPPs? A. High liquidity. B. Active management by the general partner. C. Limited liability for all partners. D. Illiquidity of the investor's interest. Answer: D. Illiquidity of the investor's interest. A primary risk of investing in most direct participation programs, DPPs, such as real estate limited partnerships, is the significant illiquidity of the investor's interest. Unlike publicly traded stocks or bonds, there is generally no active secondary market for DPP units, making it difficult for investors to sell their interest quickly or at a fair market price before the program's scheduled termination. This lack of liquidity means investors should be prepared to commit their capital for the entire life of the program. Always consider liquidity risk when evaluating alternative investments like DPPs, as getting your money out can be challenging. Question 3. A bond investor is concerned about reinvestment risk. Which of the following scenarios would heighten reinvestment risk for this investor? A. Investing in a 30-year zero-coupon bond. B. Investing in a callable bond during a period of declining interest rates. C. Investing in a bond fund with a short average duration. D. Investing in a municipal bond with a fluctuating interest rate. Answer: B. Investing in a callable bond during a period of declining interest rates. Reinvestment risk is the danger that as interest rates fall, the proceeds from maturing or called bonds will have to be reinvested at lower yields, resulting in less income. A callable bond, especially when interest rates are declining, is more likely to be called by the issuer, forcing the investor to reinvest their principal at current, lower rates. This directly exposes the investor to reinvestment risk, as their expected income stream could decrease significantly. Remember, callable bonds benefit the issuer, and in a falling interest rate environment, they often come with reinvestment risk for the bondholder. Question 4. Which of the following best describes the principal characteristic of a leveraged exchange-traded fund, ETF? A. It tracks an index and is designed to provide long-term returns that are a multiple of the index's performance. B. It aims to achieve returns that are a multiple of the underlying index's daily performance. C. It uses derivatives to provide a return that is the inverse of the underlying index's performance. D. It invests in illiquid assets to enhance returns, similar to a hedge fund. Answer: B. It aims to achieve returns that are a multiple of the underlying index's daily performance. Leveraged ETFs are designed to achieve returns that are a multiple of the underlying index's daily performance, not long-term performance. For example, a 2x leveraged ETF seeks to deliver 2 times the daily return of its benchmark index. Due to the daily rebalancing of their portfolios, the performance of leveraged ETFs can significantly diverge from their stated multiple of the underlying index's performance over periods longer than a single day, making them generally unsuitable for long-term investors. Always remember that leveraged and inverse ETFs are designed for short-term trading, as their daily reset mechanism causes compounding issues over longer periods. Question 5. An investor owns American Depositary Receipts, ADRs. Which of the following risks are specifically associated with ADRs that would not typically apply to a domestic common stock? A. Exchange rate risk. B. Interest rate risk. C. Call risk. D. Prepayment risk. Answer: A. Exchange rate risk. American Depositary Receipts, ADRs, represent shares of a foreign company's stock, allowing them to trade on U.S. exchanges. A unique risk associated with ADRs is exchange rate risk, also known as currency risk. This means that if the foreign currency weakens against the U.S. dollar, the value of the ADR and the dividends paid by the foreign company, which are converted to U.S. dollars, will decrease, even if the underlying foreign stock's price remains stable in its local currency. When investing in international securities via ADRs, be mindful that currency fluctuations can significantly impact your returns. Question 6. A client is considering purchasing a municipal bond issued by a local school district. The bond is a general obligation, GO, bond. Which of the following statements about this bond is true? A. It is backed by the revenues generated from a specific project. B. It requires legislative approval and a public referendum. C. It is typically considered riskier than a revenue bond. D. It is secured by the full faith and credit of the issuer, backed by taxing power. Answer: D. It is secured by the full faith and credit of the issuer, backed by taxing power. General obligation, GO, bonds are municipal bonds backed by the full faith and credit of the issuing municipality, meaning they are secured by the issuer's taxing power. For a city or county, this includes ad valorem, property taxes, while for a state, it could include sales taxes or income taxes. Unlike revenue bonds, which are backed by the revenue from a specific project, GO bonds rely on the general taxing authority of the issuer. Understanding the backing of a municipal bond is crucial. GO bonds rely on general taxes, while revenue bonds rely on project-specific income. Question 7. Which of the following statements about closed-end management companies is most accurate? A. Their shares are typically redeemed by the issuer at net asset value, NAV, upon investor request. B. They issue a fixed number of shares that trade on exchanges at prices determined by supply and demand. C. They are continuously offering new shares to the public and are priced at NAV. D. They primarily invest in illiquid assets and are suitable for short-term trading. Answer: B. They issue a fixed number of shares that trade on exchanges at prices determined by supply and demand. Closed-end management companies issue a fixed number of shares only once, during an initial public offering, IPO, and these shares then trade on stock exchanges like regular equities. Their market price is determined by supply and demand in the secondary market, which means they can trade at a premium or discount to their net asset value, NAV. This contrasts with open-end funds, mutual funds, which continuously issue and redeem shares at NAV. Remember, closed-end funds are closed because they don't issue new shares after the IPO, and their price floats based on market forces. Question 8. An investor is considering a long-term bond for their portfolio. Which of the following risks is generally greater for a long-term bond compared to a short-term bond? A. Liquidity risk. B. Credit risk. C. Interest rate risk. D. Default risk. Answer: C. Interest rate risk. Interest rate risk is the risk that changes in prevailing interest rates will negatively affect the value of a bond. Long-term bonds are significantly more sensitive to changes in interest rates than short-term bonds because their cash flows, coupon payments and principal, are spread over a much longer period, giving more time for interest rates to fluctuate and impact the present value of those cash flows. Even a small change in interest rates can lead to a substantial change in the market price of a long-term bond. Always remember that the longer the bond's maturity, the greater its interest rate sensitivity and thus, its interest rate risk. Question 9. An investor holding a diversified portfolio of common stocks is concerned about a potential short-term market downturn but does not want to sell their shares. Which option strategy would allow them to protect against a decline in the value of their stock portfolio while retaining ownership? A. Selling a covered call. B. Buying a protective put. C. Buying a naked call. D. Selling a naked put. Answer: B. Buying a protective put. A protective put strategy involves buying a put option on a stock you already own, or on an index that tracks your portfolio. This strategy acts as a form of insurance, providing a floor below which the stock or portfolio value cannot fall, even if the market declines. The investor retains ownership of the stock, allowing them to benefit if the market recovers, but limits their downside risk to the strike price of the put minus the premium paid. Think of buying a protective put like buying collision insurance for your car. It protects your asset's value without forcing you to sell it. Question 10. Which of the following describes a key characteristic of exchange-traded notes, ETNs? A. They are actively managed funds that aim to outperform an index. B. They are debt instruments whose returns are linked to the performance of an index. C. They represent an ownership interest in a diversified portfolio of securities. D. They are typically used by conservative investors seeking stable income. Answer: B. They are debt instruments whose returns are linked to the performance of an index. Exchange-traded notes, ETNs, are unsecured debt obligations of the issuing bank, meaning they carry the credit risk of the issuer. Their returns are linked to the performance of a market index or other benchmark, minus fees, but they do not actually hold the underlying assets of the index. This unique structure means that while they offer exposure to various markets, the investor is also exposed to the creditworthiness of the ETN issuer. Always remember that ETNs are debt instruments, so the financial stability of the issuing institution is a critical factor, as you could lose your investment if the issuer defaults. Question 11. An investor owns 100 shares of XYZ common stock. To generate income, they sell a covered call option on their XYZ shares. Which of the following statements about this strategy is true? A. It eliminates all downside risk for the investor. B. It limits the investor's potential upside profit if XYZ stock significantly increases in value. C. It requires the investor to deposit cash equal to the strike price of the call. D. It is a bearish strategy, expecting the stock to fall. Answer: B. It limits the investor's potential upside profit if XYZ stock significantly increases in value. Selling a covered call means the investor sells a call option while owning the underlying 100 shares of stock. This strategy generates premium income for the investor but limits their potential upside profit. If the stock price rises significantly above the strike price of the call, the shares will likely be called away, and the investor will miss out on further appreciation beyond the strike price plus the premium received. While it provides some downside protection from the premium, it does not eliminate all downside risk and is generally a neutral to slightly bullish strategy. Remember, selling a covered call gives you immediate income but caps your potential gains on the stock. Question 12. A customer invests in a variable annuity. Which of the following characteristics is true regarding the separate account of a variable annuity? A. It is invested in the general account of the insurance company. B. It offers a guaranteed rate of return. C. It is professionally managed and its performance determines the value of the annuity units. D. It is subject to state insurance regulation only, not federal securities regulation. Answer: C. It is professionally managed and its performance determines the value of the annuity units. The separate account of a variable annuity is where the investor's premiums are invested, typically in a diversified portfolio of mutual fund-like subaccounts, and it is professionally managed. Unlike the general account, which is part of the insurance company's assets and offers guaranteed returns, the separate account's value fluctuates based on the performance of the underlying investments. The investor bears the investment risk, and the performance of these subaccounts directly determines the value of the annuity units and future income payments. Understand that the separate account is the variable part of the annuity, reflecting market performance and not offering guarantees. Question 13. Which of the following best describes the tax treatment of qualified dividends received from common stock? A. They are taxed as ordinary income at the investor's marginal tax rate. B. They are generally taxed at preferential long-term capital gains rates. C. They are tax-exempt at the federal level. D. They are subject to a flat 15% tax rate, regardless of the investor's income. Answer: B. They are generally taxed at preferential long-term capital gains rates. Qualified dividends, which meet certain criteria such as being paid by a U.S. corporation or a qualified foreign corporation and held for a specific holding period, are generally taxed at the lower, preferential long-term capital gains rates, not as ordinary income. This preferential tax treatment makes them attractive to many investors compared to other forms of investment income. Keep in mind that not all dividends are qualified, so it's essential to understand the distinction for tax planning purposes. Question 14. An investor buys a municipal bond trading at a discount. If the bond is a zero-coupon bond, which of the following tax implications is unique to this type of municipal bond? A. The discount is taxable as ordinary income annually. B. The discount must be accreted annually, but the accretion is tax-exempt. C. The entire discount is taxed as a capital gain at maturity. D. The discount is not taxable under any circumstances. Answer: B. The discount must be accreted annually, but the accretion is tax-exempt. For municipal zero-coupon bonds purchased at a discount, the investor must accrete the discount annually, meaning they adjust their cost basis upwards each year by a portion of the discount. However, unlike corporate zero-coupon bonds where this annual accretion, phantom income, is taxable, the accretion on municipal zero-coupon bonds is tax-exempt at the federal level, consistent with the tax-exempt nature of municipal bond interest. This means investors increase their cost basis without recognizing taxable income each year, which is a unique tax advantage. Remember, for municipal zeros, the annual increase in value due to accretion is tax-free, but you still need to adjust your cost basis. Question 15. A customer is comparing a mutual fund to a unit investment trust, UIT. Which of the following is a key distinguishing characteristic of a UIT? A. It has a professionally managed, actively traded portfolio. B. It is typically designed for investors seeking long-term growth. C. It has a fixed portfolio of securities and does not actively trade. D. It can issue new shares continuously to meet investor demand. Answer: C. It has a fixed portfolio of securities and does not actively trade. A key distinguishing characteristic of a unit investment trust, UIT, is its fixed portfolio of securities, which is typically established at the inception of the trust and remains unchanged. Unlike actively managed mutual funds, UITs do not have a board of directors, investment advisor, or portfolio manager who actively buys and sells securities. Once the portfolio is assembled, it is held until a specified termination date, offering predictable holdings. Think of a UIT as a buy and hold portfolio that remains static, unlike a mutual fund that continuously adjusts its holdings. Question 16. What is the primary risk associated with preferred stock that pays an adjustable, or floating, dividend rate? A. Interest rate risk. B. Inflation risk. C. Credit risk. D. Call risk. Answer: D. Call risk. Preferred stock with an adjustable or floating dividend rate has its dividend payments tied to a benchmark interest rate, which helps to mitigate interest rate risk for the investor. However, because these shares become more attractive to the issuer when market rates fall, as their dividend cost would decrease, they are often issued with a callable feature. This means the issuer has the right to redeem the shares, potentially forcing the investor to reinvest at lower rates. Therefore, call risk becomes a more significant concern for holders of adjustable rate preferred stock. Always consider call risk when investing in preferred shares, especially those with attractive or adjustable features for the issuer. Question 17. Which of the following statements about American Depositary Receipts, ADRs, is true? A. They are directly issued by the foreign company whose stock they represent. B. They allow U.S. investors to buy shares of foreign companies directly on their home exchanges. C. They are denominated in U.S. dollars and trade on U.S. exchanges. D. They are exempt from SEC registration requirements. Answer: C. They are denominated in U.S. dollars and trade on U.S. exchanges. American Depositary Receipts, ADRs, are certificates issued by a U.S. bank that represent a specific number of shares of a foreign company's stock. They are denominated in U.S. dollars, trade on U.S. exchanges, such as the NYSE or NASDAQ, and clear through U.S. settlement systems, making it easier for U.S. investors to invest in foreign companies without having to execute trades in foreign currencies or on foreign exchanges. This convenience is a primary benefit of ADRs, simplifying international investment for American investors. Question 18. An investor purchases a Series E savings bond. Which of the following is true regarding its interest and taxation? A. Interest is paid semi-annually and is always subject to federal, state, and local taxes. B. Interest accrues monthly and is generally exempt from federal income tax. C. Interest accrues and is paid at maturity, and is exempt from state and local taxes. D. Interest is paid annually and is fully taxable each year. Answer: C. Interest accrues and is paid at maturity, and is exempt from state and local taxes. Series E savings bonds are non-marketable federal government securities that accrue interest monthly and compound semi-annually. This interest is not paid out periodically but rather accumulates and is paid when the bond is redeemed at maturity or when cashed in earlier. A significant tax advantage of Series E bonds is that the interest earned is exempt from state and local income taxes, though it is subject to federal income tax. Additionally, federal tax can be deferred until the bond is redeemed or matures. Remember, E bonds defer federal tax and completely avoid state and local taxes, offering a unique benefit. Question 19. An investor is considering a structured product that references the performance of a specific equity index. What is a key risk associated with structured products, particularly those that are principal protected? A. High liquidity due to active secondary market trading. B. Credit risk of the issuing financial institution. C. Guaranteed positive returns regardless of market performance. D. Unlimited upside potential if the underlying index performs well. Answer: B. Credit risk of the issuing financial institution. Structured products are complex, customized financial instruments typically created by investment banks. Even if they are principal protected, they are essentially debt obligations of the issuing financial institution. Therefore, a key risk associated with structured products is the credit risk of the issuer. If the issuing bank defaults, the investor could lose some or all of their principal, regardless of the performance of the underlying index or asset. This credit risk is often overlooked but is fundamental to understanding the nature of these complex securities. Always remember that the promise of a return on a structured product is only as good as the creditworthiness of the entity making that promise. Question 20. Which of the following statements accurately describes the taxation of earnings within a qualified retirement plan? Example 401k, 403b. A. Earnings are taxed annually as they accumulate. B. Earnings are tax-exempt upon withdrawal. C. Earnings are tax-deferred until withdrawal. D. Earnings are taxed at capital gains rates upon withdrawal. Answer: C. Earnings are tax-deferred until withdrawal. In a qualified retirement plan, such as a 401k or 403b, earnings on investments grow tax-deferred. This means that taxes on any interest, dividends, or capital gains earned within the account are postponed until the funds are withdrawn during retirement. This allows the investment to compound over time without being reduced by annual taxes, significantly enhancing long-term growth potential. It's a powerful benefit that helps your money grow faster by delaying the tax bite. Question 21. A back-end load charged by a mutual fund is typically associated with which of the following? A. A fee paid when shares are initially purchased. B. A fee charged annually for management and operating expenses. C. A deferred sales charge that decreases over time and is applied upon redemption. D. A penalty for investing less than a certain minimum amount. Answer: C. A deferred sales charge that decreases over time and is applied upon redemption. A back-end load, also known as a contingent deferred sales charge, CDSC, is a sales charge that is paid by the investor when they redeem or sell their mutual fund shares. This fee typically decreases over time and may even disappear after a certain number of years, example 5 to 8 years, that the shares are held. This structure encourages long-term investing as the penalty for early withdrawal diminishes. Remember, a back-end load is a charge you pay when you exit, designed to discourage short-term trading. Question 22. A customer is considering a non-qualified annuity. How are earnings within a non-qualified annuity taxed upon withdrawal? A. All withdrawals are tax-free because contributions were after tax. B. Earnings are taxed as ordinary income, and contributions are returned tax-free. C. Earnings are taxed at long-term capital gains rates. D. All withdrawals are subject to a 10% penalty. Answer: B. Earnings are taxed as ordinary income, and contributions are returned tax-free. In a non-qualified annuity, contributions are made with after-tax dollars, meaning the principal portion of withdrawals is returned tax-free. However, the earnings that accumulate within the annuity, which have grown tax-deferred, are taxed as ordinary income when withdrawn. The IRS generally applies a last-in, first-out, LIFO rule, meaning earnings are presumed to be withdrawn first and are therefore taxable until all earnings are depleted, after which the tax-free principal is returned. This LIFO tax treatment ensures the earnings are taxed first, so be aware that your growth is subject to ordinary income rates upon withdrawal. Question 23. An investor purchases a callable bond. Which of the following is a primary risk for the investor if interest rates decline significantly? A. Credit risk. B. Inflation risk. C. Reinvestment risk. D. Liquidity risk. Answer: C. Reinvestment risk. A callable bond gives the issuer the right to redeem the bond before its maturity date, typically when interest rates decline. If rates fall significantly, the issuer can call the bond and reissue debt at a lower interest rate, which is advantageous for them. For the investor, however, this means they receive their principal back sooner than expected and are then forced to reinvest those funds in a lower interest rate environment, thus exposing them to reinvestment risk. Remember, callable bonds benefit the issuer, and a falling interest rate environment makes them particularly risky for bondholders due to reinvestment risk. Question 24. A customer invests in a real estate investment trust, REIT. Which of the following statements about REITs is true? A. REITs are typically illiquid investments due to their direct real estate holdings. B. REITs are subject to corporate tax on their income before distributions to shareholders. C. REITs are generally required to distribute at least 90% of their taxable income to shareholders. D. REITs primarily offer significant capital appreciation with little income distribution. Answer: C. REITs are generally required to distribute at least 90% of their taxable income to shareholders. Real estate investment trusts, REITs, are companies that own, operate, or finance income-producing real estate. To qualify for special tax treatment, which allows them to avoid corporate income tax, pass-through entity, REITs are generally required to distribute at least 90% of their taxable income to shareholders annually. This structure means they typically offer high dividend yields, making them attractive to income-focused investors. This requirement to distribute most of their income means REITs are primarily income-generating investments. Question 25. Which of the following types of preferred stock offers the investor the highest potential for capital appreciation? A. Cumulative preferred stock. B. Callable preferred stock. C. Convertible preferred stock. D. Adjustable rate preferred stock. Answer: C. Convertible preferred stock. Convertible preferred stock offers the investor the highest potential for capital appreciation among the choices because it can be exchanged for a specified number of common shares of the same issuing company. If the common stock performs well and its price increases, the value of the convertible preferred stock will also tend to rise, reflecting its conversion value into more valuable common shares. This allows investors to participate in the growth of the common stock while still receiving regular preferred dividends. If you're looking for preferred stock that offers growth potential, convertible preferred is your best bet because it links to the common stock's performance.